C Vijayakumar, the CEO and Managing Director of HCLTech, spoke to us on the highlights of the quarter gone by. Here's a slice of that conversation.
From an overall perspective, it's been a strong quarter, and we've delivered growth across the board. I think that is the fantastic aspect of the Q2 performance. And we did indicate in the beginning of the quarter that we're going to grow in all the verticals except financial services. So we had some visibility getting into the quarter, but the way it played out, it came out better than even what we had expected. And financial services, excluding the divestment impact, has also grown very well. So I think the real underlying theme is some of the discretionary spend is coming back, though the growth is equally balanced between discretionary spend and the non-discretionary kind of work, which is really ramping up of the cost efficiency-led programs. I think it's just picking up. I guess we have to wait and watch how sustainable is this. But at this point, we've had a good outcome.
So, CVK, when I looked at it geographically, right, EU did well, APAC did well, very strongly, US was flat. The belief, as per some companies that we spoke to earlier, was that maybe clients will wait till the November elections are out of the way and then direction will come in. Do you sense that in your top clients that maybe some spends are being held back or decisions are being held back until the decision is out of the way, the election result that is?
I'm not sure if there is a direct correlation, but if you see the US has grown 7.5% year on year, which is again a very strong growth.
Okay.
Europe has also grown maybe 4.2% year on year, and Asia Pac, which is a growth market, has grown 7.2% sequentially and a slight decline on a year-on-year basis.
Yeah, so I mean, I was looking at it, sequentially only, and sequentially EU and APAC did so well, which is why I was wondering that...
No, I think it's because of the divestment, which is largely in the US. Okay. If you exclude that, I think US growth is also very handsome.
Okay, so
on a sequential basis.
Got it. So you're not seeing a direct correlation. Thank you. Coming from you, that means a lot. So, it's a question that is to be stopped asking to people about the US election and the IT spends. Great. Good to know that. I did hear you say that cost takeout deals and discretionary spending in select pockets is showing the initial signs. Is it the nature of the beast that is compelling you from kind of giving a more constructive comment there, or is it just that the environment continues to remain volatile and therefore predicting is becoming difficult?
Yeah, I think for example, in 2022, we were very optimistic in October, but November, December, things turned in the other direction. So I think we've seen a lot of volatility in how this has played out over the last maybe 8 quarters. So to that extent, we recognize that we are in a difficult geopolitical situation, macro environment, and all of that impacts our clients in some way or other. So to that extent, we are being cautious.
Yeah, but the deal wins TCV, CVK, and at point I was reading this out of a brokerage note which has done the past analysis as well. At 0.65 book to bill, they are saying it is in line with past trends, and they are taking heart from that. Are you also kind of okay with these numbers in the current environment?
No, I did call out in one of the interviews that we would ideally like to do a little bit more booking to help with the strong growth in the subsequent quarters. But we are very close to that number. So we did 2.2 billion. So a little bit more will be better. But I think we have a plan of enhancing the sales presence in certain verticals, some more clients. All of that should lead to better booking. And our pipeline is at a near all-time high. That should also help us get better booking in the subsequent quarters. And the book-to-bill comparison may not be accurate because we don't include the renewals in our booking. We only have new business, both from existing customers and new customers. So the book-to-bill ratio may not be a right way of looking at this.
Okay, thanks for correcting me on that as well. Now, one point though, I believe in the commentary yesterday, you've probably mentioned that the automobile ER&D spends are not quite as strong maybe. I don't know the exact numbers, but not verbatim, but something like that. And it showed in the way the guidance came in from the two European majors as well. How sketchy is this piece, CVK?
I think there are certain clients who are going through significant challenges, so they're probably uh, canceling some programs, but also embarking on significant cost optimization type of scenarios. So I think that does have an impact. Uh, at least a couple of clients in Western Europe, we see this challenge.
Okay, but sorry, the only reason why I'm kind of interested in just probing this a bit more, because all the companies which are so focused on auto ER&D have told us all through the years that when companies are embarking upon the tech enablement programs, they are multi-year programs, and if anything, it could be 1 or 2 quarters of a delay, but it will not be a cut back in spend. What is your view here on this?
See, I mean, it is, I don't want to comment on any specific companies because everybody has certain areas that they play in, and they would be the best to comment on it.
Agreed.
But my comment is more at a very high level of what some of the top automotive companies are talking to us about. I think there is stress, and then that will mean that some of the existing projects would be slowed down or completely stopped. And there will also be an equal emphasis to look at how to optimize cost, which could also throw up new opportunities for us.
Got it. Okay. Yeah, fair, fair. I was not, sorry, I was not asking you to comment on others, but I just wanted your view on this piece because you are also such a large segment for you as well, so to say. Just a couple of quick comments, CVK, before we wrap up. One is on EBIT margins. Very strong number. Despite wage hikes, you are confident of 18-19%. Is this cost efficiencies or are there other things at play?
Yeah, I think we have a program called Project Ascent, which is focused on extracting more efficiencies using technology like automation, Gen AI, but also reskilling our people so that our utilization can go up. So that's why you see that even though the headcount is moderated, we still grown because some efficiencies have been extracted and they have been redeployed. This has been happening since May of this year. So I think we are quite confident of the 18 to 19% guidance. That's what we guided last year. We delivered 18.2, and the first half we've done in line with our expectations. And second half, usually Q3 is a seasonally strong quarter for the software business, so that will also help in the margin trajectory.
Noted well. One last question, CVK. Where is the, I mean, the whole commentary about 3 quarters ago was how AI will disrupt. Suddenly, the whole disruption of AI for Indian IT is not even being featured in commentary thus far. Indian IT adapting well to the AI challenge / opportunity?
I cannot comment for everyone, but we are on the front foot. We are being much more proactive about talking about how services can be transformed using generative AI, and that's what the AI Force platform brings to the table. A lot of customers have looked at the platform and they feel quite excited about the practical approach that we've taken to deliver some very good benefits in the entire life cycle in the IT operations and the software development life cycle. So I think that adoption is picking up. We've already deployed it, at least some part of AI Force in 25 customers. So we are not shying away that there is going to be efficiency and what would happen to our revenue and things like that. We are being proactive because I think by being proactive, customers will see greater value with what we can do. And of course, it will be a good foundation to increase the wallet share in some of the large clients.
That's HCL Technologies for you, and pull up the stock. It didn't have the best of starts. I mean, it started off okay, nothing too great, even currently just about 0.25%. But if you pull up the 1 month piece for HCL, 1 month chart for HCLTech, and that shows that relative to a TCS, for example, a slightly better performance, 2.73 or nearly 3%, compared to the 1 month for a TCS, and that stock has been drafting lower. So in some sense, a better performance thus far by HCLTech and the Infis versus the TCSs of the world. So that's the long and short of HCL Technologies. Cautiously optimistic.